A mixed picture on the economy today. Production rises by the most since August, but new home construction sees its biggest decline since March of 2009. To put it all into perspective, we go now to Dean Maki, one of our Bloomberg bests, which means he is one of the most accurate forecasters in the world when it comes to the housing market. Dean is the chief U.S. economist at Barclays Capital. He joins us now from his firm here in Manhattan. Dean, welcome back to Bloomberg News. Always good to have you on.
Thank you for having me on, Mark.
Dean, what does this mixed picture tell us?
Well, I think there's really two messages coming out of the data today. First, the manufacturing sector continues to roll along. In the second quarter, right now, manufacturing is up 10.8% annualized so far in the quarter. That's a very strong quarter of growth, and it does suggest GDP growth is accelerating. At the same time, the housing data was on the soft side. That's just telling us that this homebuyer tax credit did shift some activity around over time. We think the underlying trend is still upward, but the tax credit is really throwing a lot of volatility into the data.
So at this point right now, we're seeing that the manufacturing is the engine that's driving economic growth.
That's correct. The manufacturing sector is what led us out of the recession and into recovery, and it continues to be the sector that's powering the economy forward.
Talk to me then about these comments that we've been hearing from people, concerns about a double-dip recession because of what's going on in Europe. Could that put the brakes to what's going on here?
Certainly there's some risks from what is happening in Europe, but at this point we don't see it as likely to generate a significant slowdown in the U.S., much less a double dip. The reason is that there's several offsetting forces here. It is likely that U.S. exports to Europe may be hit by this a bit. But on the other hand, we have lower gasoline prices, and as well we have the interest rates are lower in the U.S., largely as a result of this crisis. So the effect on the U.S. is quite mixed. And if we had to pick one of those influences as the dominant one, we think it's the lower gasoline prices.
Dean, talk to me about housing starts. Are we going to see a turnaround at all this year, perhaps in the latter half of 2010?
We do think that after this couple of months of softness after the homebuyer tax credit, that housing starts are going to resume their upward trend. If you look at the past year and a half, housing starts have been on a gentle upward trend, but that trend has been a lot of volatility put into it by this homebuyer tax credit, both in the last half of last year and then this spring as well. So we think that's volatility. It alters the timing, but doesn't change the trend, which is gradually upward.
Dean, we still hear stories, though, as you're no doubt aware of what's going on in various regions of the economy in terms of the housing market, still seeing foreclosures, still seeing people underwater. Are you seeing any signs of hope?
Well, there's still a very difficult situation in a lot of areas, so I certainly wouldn't want to minimize that. What is happening, though, we've seen new home sales and housing starts begin to rise in areas that don't have massive foreclosure overhangs. So, for example, if you're a household, say in Texas, that wants to buy a new home, it doesn't help you to know that there's foreclosure inventory in Las Vegas. It's irrelevant to you, and it's in places like Texas that we're seeing new homes being built and sold. That's what's forming the basis of the recovery.
Dean, can we talk quickly about the FOMC? When do you see some tightening occurring? Is that going to happen this year, or are you pushing that back even further?
We think that it's not going to happen until the spring of 2011. The fiscal crisis in Europe is a factor, we think, that delays the Fed. As we get towards year end, we think the Fed will start focusing more intently on the fiscal tightening that will be happening in the first quarter of next year, and only after they're convinced that that fiscal tightening won't slow the economy down sharply will they begin the tightening process.
And when that tightening process begins, when that move on rates begins, is there going to be any relationship between that and the unemployment rate? Because the school of thought has been that the Fed would not move on rates while the unemployment rate was still this high.
We agree with that, but we believe that the unemployment rate is going to be dropping much more significantly than many others believe. For example, we believe that by the end of this year, the unemployment rate will be about 9%, and that it will continue to drop next year. So that is a required condition for the Fed to start tightening, is that the unemployment rate is on a downward trend. We think that will be happening.
All right, Dean Maki, chief U.S. economist at Barclays Capital, joining us from his offices here in Manhattan. Dean, it's always good to have you on. Thanks so much for your perspective. We appreciate it.
Thank you.